2026 is shaping up to be a strong year for multifamily for several reasons. First, the supply wave is rolling over. New deliveries are expected to decline meaningfully in 2026, down roughly 43% from the 2024 peak. As supply pressures ease, we expect rent growth to gradually reaccelerate over the course of the next year. On the demand side, absorption was very strong in the first half of 2025, and followed by a slowdown in the second half, thanks to seasonality and so on. With homeownership still largely out of reach for most renters and would-be buyers, we expect renter demand to continue to outpace new supply. Rent growth was challenged last year, particularly in the Sunbelt markets, as the 2024 supply wave really surged, particularly in those Sunbelt markets, but it created a temporary oversupply in those markets. As that new product continues to be absorbed and concessions burn off, rent growth should become more achievable and sustainable throughout 2026.
All right, so let's start with talking about rent growth. I mean, look, when I talk to investors for multifamily, they're really expecting rent growth. It's a big part of their investment. So talk to me about the expectations for rent growth more in 2026, and how does that really how are investors betting on improving fundamentals?
Yeah, I would say it's nuanced, right? If you look at the last 2 to 3 years, the coastal markets, which were the laggards of the previous cycle, have been the strongest. Part of this is a supply story, right? Where they've just seen significantly less supply. Chicago and New York, even this past year, San Francisco is the top performing rent growth market. That said, we're starting to see improvements throughout the Sun Belt, particularly in the Southeast and Southwest as supply pressures decline, as I mentioned earlier. Broadly speaking, most of the top 50 markets are going to see operational improvements this year. So roughly 40 of these markets are going to see occupancy and rent growth both accelerate year over year in the fourth quarter of 2026 compared to 4Q 25. So I think it's nuanced by market. I think if rent growth ends up being more muted than expected, capital will likely gravitate to where opportunities exist in higher barrier to entry markets. I say that because those markets have a really sticky occupancy base, and operators are able to raise rents on renewals. We've seen a pretty big divergence between renewals and new lease tradeouts. It's almost 6.1% over the last 12 months. So keeping those tenants in place has been accretive for operators' ability to raise rents at a better pace in a slow growth environment. Another area we're probably watching pretty closely is stabilized new properties. We recently looked at RealPage data, and based on all deliveries in 2023 through 2025 that have reached stabilization, the vast, almost 95% of them have not come close to hitting that market rate average for occupancy. Many of these assets are trading below replacement cost and generally require a lot less capex than investing in a value add or opportunistic kind of transaction. So we see that as opportunity as well.
But Mike, from a renter standpoint, though, how much higher can rents realistically go right now before buying a house starts to look more attractive and makes more economic sense?
In nearly every market throughout the country, it still makes more sense to rent. If you look at the spread between homeownership and renting an apartment. With that said, there's also something else going on. Nationally, the 30-year fixed rate mortgage, if you were to be a new buyer of a home, is about 43% over the effective mortgage rate currently. So those are people with existing loans on homes, right? That spread is so large that you won't see a lot of people wanting to trade out of their existing home. So we still think it's less attainable for many renters or would-be buyers. And I don't think that's something that changes overnight. At the same time, real wage growth has accelerated. Inflation is, as others have mentioned, it's stubborn, but it's not as high as it was 2 years ago. So between that and the wage growth aspect, it's actually outpaced rent growth in most markets. So it's made renting comparatively more affordable and supports demand.
So Let's talk about debt markets very quickly here, because there's a lot of momentum, and actually we can expand that and just talk about transaction activity in general, because you have FHA really pushing up their limits, as well as the possibility of 401ks, right, kind of being entering into the transaction space. So can you expand on what that kind of means for
Yeah,
multifamily for and capital markets?
yeah, this is huge. The what you mentioned, Joe, about FHFA, that just means the capacity for Fannie and Freddie to lend on multifamily properties is going to increase by 20.5% this year. Also, the Mortgage Bankers Associates or Association is projecting a 16% increase on originations this year. So liquidity conditions are clearly improving. I think we've seen that on the debt side for the better part of the last 2, 3 quarters. So that's really positive also for transactions overall on the investment sales side. Joe, what you mentioned about the 401ks, this is something that we've kind of been talking about as a wild card prediction, but it's I think we're already starting to see it. In this document that will be coming out, we talked about, and this was, in December when we were kind of putting the, icing, just putting the final touches on this. In early January, just 2, 3 days ago, there had already been talks about some of the larger private equity funds starting to offer private vehicles, not so much real estate yet, but other vehicles into 401k plans through major fiduciaries. Why this is huge is multifamily already represents over a third of all U.S. commercial real estate transactions. So broader access to that retirement fund ecosystem is a significant benefit to multifamily in particular, especially for capital flow. So we see that as a really big positive going into this year. And, it does seem like the current administration is a lot more friendly to these kind of private equity groups that we see this as a pathway for, greater transactions and more capital flow.
Well, thanks, Mike. Appreciate the insights into multifamily.